Thank you everyone for being here today. My partner Matthias and I from WCG Investments are going to talk about the latest deal that we're under contract on, a little bit of what we've learned in the week or so of due diligence, and discuss a little bit about what we are doing in the mobile home park space. Thanks for being here, Matthias.
Yeah, thanks for having me. Excited about this one.
Yeah, so give us a high level on this deal.
Yeah, high level. It's 283 lots. It's across 5 mobile home parks, all in the Oxford, Anniston, Jacksonville, Alabama area, all within like less than 30 minutes radius to each other. Pretty good sized parks. One park itself is like over 100 units, which is the biggest park out of the 5. They're all right off Interstate 20 in Alabama, which connects Atlanta and Birmingham, and it's kind of like that smack in the middle, that portfolio. And it's really close to like the Honda manufacturing facility where they're building all the Honda Odyssey minivans, which is super high, popular product that they're building there. And Honda has a pretty good, foothold there in the area. So it's within 25-30 minutes commuting range to these parks. So that's what really attracted us to these parks as well, because there's a lot of different industries there, especially big manufacturing, and it's a pretty, solid manufacturer being Honda, and for a high popularity product as well on top of it. We know what can happen when we look at Detroit back in 08, 09. Just because you have manufacturing area doesn't mean it's like recession resistant. Automotive gets usually hit pretty hard, obviously. But Honda is a really good and stable manufacturer, obviously, and the Honda Odyssey is like a really popular product as well. So looking, a little bit deeper and granular under the hood, we really like to see that stuff as well, with very popular manufacturers in the area. There's all other manufacturing. There's healthcare in the area. There's military in the area. So it's very diverse, and it's growing a lot. So what we really like about Alabama too is like the lot rents are not super high compared to other states, so there's a lot of room for growth, obviously. So that's really good. And currently they're all under market lot rents at the moment, so there's room to grow right at the gate. And we have that massive scale once we take over, because we can bump rents $50, $75 per each lot, and we have 283 of those. So that's huge upside right out of the gate, low hanging fruit, if you will. This is a tailwind we really like, when we go in. That's very easy value add, which drives up the value tremendously and drives the returns for our investors. Nice.
I like that it's, right off the 20. I mean, the 20 connects North Carolina to California pretty much, it's a major interstate highway in the country. And it really shows me that, like, sure, they're relatively smaller towns, but there's life, going through it. Plus, being 60 minutes outside of Birmingham, it's really kind of an undertapped market. And I'm excited for Alabama. I'm excited for this to be our first project in Alabama. I've seen a lot of good stuff in Alabama, and a lot of stuff that has traded above what we have been able to offer. So I'm glad that, we finally got something that really made sense for us to take down and give investors, our investor partners the returns that they need. So I'm excited about that. So we've had like a week or so. What have we learned in due diligence so far?
What we really learned is that when you're buying 280 units, that the owners are much more sophisticated than mom and pop operators. So the organization of documents and cleanliness and everything of the documentation and financials and how the money flows is very sophisticated, which makes it a lot easier to take everything apart. We bought deals before where you just had like back of a napkin, financials, and everything was in the head of the seller, because they were smaller parks. But in this case, every single park has its own bank account, it's nicely organized. All the transactions are very easy to follow and reconcile, which makes our life a lot easier to confirm how the income looks like, if it's really up to what the seller promised us in the beginning, and also if they're expensive, they're online. So right now we're in that phase where we actually taking the entire financials apart, we reconciling with the bank statements that we're getting from the seller for that same time frame. And we, in our underwriting model, we have our pro forma, or on the side-by-side tab really on our model. On the left side is the seller financials, on the right side is year one for us pro forma, and in the middle is where we put all what we find in DD, like due diligence. and then we see what the deltas are, the differences are, and then if there's anything standing out, we're asking some really good questions, obviously, to the seller. And sometimes it can be wildly off. I mean, we backed out our deals before in the past where all of a sudden income was like half of what they promised in the beginning. And then, of course, we backed out because it didn't support the deal anymore. But that's what we discovered so far. And also, there were some questions about who owns the road in one of the parks in Oxford, because it's very fragmented. It's like a section right off of I-20, but it's like there's a park on the hill, but there's divided by a road, and then there's like another like long road, and then there's like a section of park again, there's single family homes in the middle. So it's very fragmented. It's like several parcels within that one big park. And the question was who owns these roads, and we realized that we don't even own them. Although the seller said we own them, with we I mean the seller, that means if we would buy the park, we would own the roads, but it's actually not the case. So in due diligence we discovered we don't even own these roads, which means, I mean, we could technically fix them. The county would say probably thank you very much indeed, but they're technically their responsibility. So that actually helps from the CapEx perspective. We don't have to spend that money on it. We just have to push the county really hard to fix these roads up and patch the holes and stuff. So there's some initiatives that go through my mind that we can work with the residents, actually put a lot of pressure on the county and say, hey, you have to fix those potholes there on these roads, and they're not our responsibility to fix. So that's actually tremendous progress, because they will keep the capital outlay low for us, because we expect to actually fix these roads and pave them, whereas the others will have pretty decent roads. So
I remember, driving through there because I was the one driving, and oh my gosh, some of those potholes were intense. That's, good news that we don't have to put the money in to fix it, but yeah, it's definitely gonna be, when we're operating it, us probably constantly bugging the county and or city or whoever's responsible to like, hey, do something, please.
Exactly. Yeah, my back still hurts. I wasn't in the back seat, and my back still hurts when we hit those potholes. They were pretty bad. I think you can hide a small child in those potholes. Pretty bad.
Oh man, that was something.
Other than that, I mean, it's week one. Technically, how we structure the deals for our audience is our due diligence is usually 45 days. And the 45 days didn't start yet. So what we always do is the due diligence only starts when we receive all the documents from the seller and we accept that the documents are complete and there's nothing missing. We're in that stage right now. We just received it on Friday last week. After the day of the recording today is Wednesday. We're going through everything to make sure everything is there, and it's hundreds of documents obviously that we're going through: tax bills, financials, bank statement, you name it. It's hundreds of documents. Once we give them a green light, then the 45 days start. But as we going through it, we have a due diligence team that goes through this, which means, as we are reviewing everything, part of the team is always starting reviewing the documents in detail, like the financials, county records, etc. Calling the zoning department, calling the county and stuff like that. So we actually get a little bit of a head start with DD. So we actually have more than 45 days. So it's kind of a sneaky way to do it, but the seller accepted it. We have it in the contract. So that's one way how we protect the investor capital too. We don't have to rush for due diligence. We have usually plenty of time for due diligence. The next step for us will be, besides our team going through everything virtually, the next step will be that we actually go on site. We've been on site before, obviously, for numerous days before we even got on the contract, but now we go on site and walk all these homes that we would own, all of them, and talk to residents, get a feel. Because when we did the first drive-through, we're not allowed to talk to tenants, and we just drive through. We didn't talk to tenants, all respect, obviously, but then now it's the time in due diligence to talk to the tenants, and nobody's more honest than a pissed off tenant. They're gonna give you all the bad, the good, bad, and ugly, especially the ugly, and then you have to take a lot of notes, and then we know what needs to be fixed. And sometimes if they're really in a bad mood about things, you know exactly what to attack, what needs to be improved, and you come in as the new owner and you're the hero, because you're fixing those things that they dislike. And some things they dislike you won't change because, they don't like the rent is too high or whatever. Nobody likes to pay rent. But this is like a little mini survey that gives you a little bit of a head start for, operations day one.
I really like that, we start ahead of time. It doesn't make sense to leave stuff to the end because, we both know in real estate there's always some weird random thing that happens, and so it's like making sure we're taking care of that with plenty of time to go. I also remember one of the parks had I think we were there on a weekend because it was like midday, if not later in the day, and there are signs of life there. So there's kids and like playing in the road, or not in the road, but So it definitely they're pretty close to the like epicenter of these smaller Alabama towns, and so there's definitely life there. And then even the one that is the most rural of them, like it was nice and quiet. So it's like there's still signs of life, but there wasn't any rowdiness, and no one knew that we were coming through. Like I mean, the owner, the seller did, but like no one else knew. He wanted to keep it under wraps just in case we don't buy. That's kind of what happens with real estate. So it's not like anyone was performing or anything. It's just these are nice small community parks. I really like that about them.
Yeah, me too. That one park that it's in Jacksonville, Alabama is really nice because like a little college town. It reminded me a lot of like Clemson in South Carolina. Like a little college town. It's like nice and neat and organized. A lot of youth there.
You're gonna get all these South Carolinians and Alabama people who are like pissed at you that you would even think to make that connection.
Yeah, didn't they have like a team that's called the Gamecocks? Yeah. Didn't we joking that they have like the names that actually in South Carolina? I think there's like the Tigers and there's like the Gamecocks. I was like, what? Trying to copy South Carolina?
Oh no. Yeah, they did though. They did. We joked about that.
But yeah, I like that too because we actually what we did like when we did our first walkthrough, because we were on a contract, so we kind of like having fun and just like be open and talk to people. Hey, how do you like it here? So we went to like coffee shops, and coffee shops are always a good sign. There's a lot of fancy coffee shops out there in that little town. So that's a good thing, talking to people, and they like the area. There's a lot of growth there. I like the Oxford and Jacksonville area that grew over 50% in the last 20 years, which is amazing. Whereas Anniston in the middle, that's 2 out of the 3 parks. That's like very stagnant population. It's not a small market in any shape or form. It's just very stable. It's like a little decline, a little bit of stagnant population. But there's massive growth in Oxford and also Jacksonville. Jacksonville probably because it's a college town. And Oxford, I felt like there was a lot of traffic. I didn't expect that for a town of this size. There was actually a lot of traffic there, remember? When we drove through it, and that's all the major retailers. I mean, that Oxford Circle Park, which is half the portfolio, that one is within like 5 minutes or less of Walmart, CVS, Walgreens. I-20 is like right next door. It's like you right off the exit. The location is phenomenal. And then let's think about it, right? Like the people live in these parks, the blue collar people that work at Honda, for example, 30 minutes down the road, they would love to live there because they go straight on I-20. And then in Lincoln, Alabama, 30 minutes down the road off I-20, literally a Honda factory is 20 minutes down the road, 25 minutes right off the interstate I-20. So you basically just hop on the I-20 and hop off the exit 20 minutes down the road, don't stand a lot of traffic. So I think that's great for commuting as well. So people will probably be very attracted of the location for Oxford Circle, that one mobile home park you'll be looking at.
I'm also really excited. I just finished sending Eden from Madison Specs like all the information that he needs on the parks to get a proposal. So with all of these things, there's so much tax advantages. I was talking to someone yesterday, and they said, "Hey, I heard about you, and I have a problem where he is W-2 right now, but is dropping the W-2 to focus on real estate, and his wife is a dentist. He's gonna get reps status, so real estate professional status, and basically they've got a big tax problem. He and his wife are both high earners, and so like he was like, hey, we've got this problem, and I'm like, that's perfect. Here's an example, of what we've done in the past, and I could reference the K1s we got last year. Of course, still waiting on them this year, but it was like, oh yeah, we were like 1.25 to 1.5 times of what people put in. It's probably going to be more now with the 100% depreciation back. But yeah, so anyway, he's excited. We're going to send him info on the Alabama deal. But yeah, I look forward to seeing kind of where we are at now with the projected year one depreciation from him. That's always a cool number to see. And to be honest, like sending people those super negative K1s is one of my favorite things.
I know, I love it. I love the cost segregation study. It's definitely, there's cost attached to it, but it's usually like what, like $5,000 per park or something you pay, but you know, it brings so much returns to our investors. And even to us as the managers, right? We all benefit from it. All of us benefit from this. It's just amazing. It's really cool. It's almost like a magic trick.
Yeah.
It's a tax magic trick. It's pretty cool. What is also amazing, like what I'm working on right now, is already talking to our insurance broker, right? So maybe the audience doesn't know, but since we have a lot of scale now, WCG Investments, with 25 mobile home parks, over 1,100 units, we switched to a master policy for insurance. For general liability and also property insurance. And so that actually enabled us to save about 15% of our total policy, which is huge. That translates into millions of dollars in value for the entire portfolio. But also, like as we're getting bigger and we're buying these parks, if you look at the sellers' like financials and they don't have a portfolio of our size, for example, that could actually mean you can actually reduce your cost on insurance compared to what the seller was paying. So you have an immediate, like a value increase right there, because we are pitching it, basically to our insurance broker and put it on top of the master policy. And the more you put into the master policy, the less risk there is for the policy holder, basically, because the risk is spread out among different parks, different areas, etc. And then you get a really good rate at that point. And so that's what I'm really excited about, to see what we're coming back with if there's a major drop. Because it's one of the things why you do the master policy, to kind of throw your weight around and use the scale that you have. And so really looking forward to seeing what comes back there, if you get some instant value boost out of the gate at day one, right? So yeah, I just kicked it off yesterday and super excited about it.
I like that you brought up it's like spreading the risk among all these properties. The same thing came up in that conversation yesterday. I was saying, we haven't done it yet, but we're working on opening up an equity fund. The attorneys are all talking about it. So obviously this is not a solicitation right now or anything like that, because nothing's open at this moment. But we are in the process of getting that 506c fund open. And he was asking, why is that the next step? And I said, well, for us, it is. It's 100%, diversifying across different assets, diversifying and spreading that risk, because everything has risk to it. And a big part of our thinking is really, how do we decrease that risk for everyone? We're very aligned with our investors in that we don't want risk in the same way as they don't. We like sleeping at night. And I mean, two of our deals that aren't performing the way that they should be performing, that we underwrote in our pro forma, we turned off payments to ourselves, because like that's the right thing to do for the project and for the investors, to make sure that everyone else is getting taken care of. But yeah, we don't like to do that. I don't like to work for free. No one likes to work for free. So the whole idea is that we are spreading risk out, that we're diversifying. So we're opening up a fund so we can have multiple assets in that entire fund, to make it, so that risk is spread out and it's just safer for everyone involved. So I'm excited about that, dude.
Me too. I think it's great. I mean, thinking about it, you basically at that point investing into an asset class or the operator, which you do anyway in the syndication, but you're also in the fund end, you're spreading it out over like a large scale of mobile home parks, not just like one deal. But you're buying portfolios, so you have like 5 parks over here and this syndication, or 4 over here. But if you do in the fund, there might be 10, 50 mobile home parks at the same time. So if, let's say, 2 don't go as well, or it takes a little bit longer to stabilize, your returns are pretty much protected with the other 13 parks or whatever it is. They're still performing really well. So it's like almost like a mutual fund, right? Like if one stock tanks, the other 499 might be fine, other S&P 500, it's the same thing. Depends how big that one is. Obviously, if Apple tanks, I think this S&P 500 will be hurting, but it depends who it is, of course. But in the mobile home parks, it doesn't really work that way, obviously. So there will be, obviously, they have all, similar sizes, obviously. So the risk is going to be spread out pretty nicely for investors.
Yeah, I like that. And I did mention, the 2 deals that aren't doing well, that we turned off our payments to ourselves. And fortunately, in turning those payments off to ourselves, we are hitting the targets, right? So we got some work to do for sure, but we're still very cognizant of making our investors whole. So yeah, I mean, let's talk a little bit about the fund and kind of where we're going from here. What's the next step in your eyes?
Next step, right now we're about to really launch it, so we have the fund open as an offering to our investors, and then basically we're just gonna roll it out and let our investor base know this is open right now, and educate them on why the fund and why we're doing it and why it's good for them, and also makes capital raising also for us easier, which then helps the investors too, because it costs less. You don't have to do, each syndication costs a lot of money. You have all the PPMs you have to create for each deal. This is like $15,000 or so at a time for each deal. If you create that one fund, first of all, it's cheaper than $15,000 to get a fund created, and then you can actually absorb several deals at the same time, which we have to raise less capital in that case on a per deal perspective, which will improve the returns to the investor, which we need less money for closing costs, right? So everybody wins. So that's kind of great. And also, we could create several funds, right? So the first one we're gonna have right now, we anticipate to have that one really filled up really fast because we have a lot of interest already coming in. So that one will be really, really quickly filled up within a few months, I would assume, or even quicker than that. But for the audience, rest assured there's going to be more funds coming down the road, but timing is TBD, obviously. So that the first one, definitely keep an eye on future updates on when the opening is for the offering. And if you want to get in, don't hesitate, please, because we have so much interest already from our investors that want to get onto that fund. Please pull the trigger as quick as possible, because just make sure you get on the next couple of deals that we're working on right now, because it's already March as the time of the recording. At some point you cross that threshold where it's too late to get the tax benefits because commercial deals take a while to close. So if you wait too long, you might not get on the boat for the tax benefits till 2026, right? So keep that in mind for the timing's sake.
Yeah, I think also, we talked about this a little bit, and obviously we don't have the fund open yet, so I don't know anything 100% just yet, but talking about like our friend does, who if you want to reserve your spot, put 10% of your total, what you want to put in down, so that kind of keeps your spot. So stuff like that is really what we're going to try and encourage, is if you have any interest, put in a soft commit. You don't have to put that 10% down just yet, but at least put that soft commit in. And if you, look through it and you want to go in, put that 10% down, and that'll guarantee you your spot. Definitely, it was crazy good to see how quick we filled up our last deal. And there are definitely a few people who didn't act quick enough, and we had to either return their money or tell them that they couldn't, we didn't have any room for them. So it's real, dude. Yes, it is only March, but it's going to be November soon enough, and there's going to be people asking, hey, I need tax savings. What do you got? And we're going to be like, got nothing, probably. And it's just a reality.
Whatever is pending won't close until January or February, at that point. That's what it is. We probably have something cooking, but it won't close until the end of the year, so you don't get the tax benefits until 27.
Yeah, exactly. But if you're watching this and you're at all interested, let's have the conversation now instead of then. And then, for WCG as a whole, the way I see things, probably doubling our portfolio until we really look at different areas of the country to invest in. So, we do have the big goal to get to 100 million AUM by the end of this year. And probably, when we hit that, looking at different areas. Where have you thought of? Where's our next place that we're going to go?
I think we talked about a little bit on the sidelines that we look into the Midwest, because Midwest has some really good markets, stable, growing markets. I think that's a good one. A couple states out there. I mean, we already have something in Oklahoma, obviously. So anything around that area, it's always welcome, I would say, because that park performs really well. So I like the OKC market a lot. So anything north of that or east of that, not anything, but some states out there that I think are really good. even like we're in the southeast right now, but we don't have all the southeast covered, right? So we have some Florida markets we're looking at and making some moves, but Florida can be a little bit tricky to get into. It's pretty pricey, overpriced really, especially when they hit market. And then also, Tennessee has some good markets, Kentucky has some good markets. So something like that, we maybe want to dip into those new states as well. We want to look at. And of course, strengthening where we are already. Use the scale we have. We're still going to be bullish on South Carolina, North Carolina, Georgia, Alabama, especially. That's where we have the majority of our portfolio right now. But on the new markets, I think like the Midwest is going to be a good one. Then dip a little bit further south of Florida. I think there's a lot of opportunity. There's a lot of parks here as well if we strike the right deal. So, but every market behaves a little bit differently. Has different growth projections and stuff like that, so you have to kind of look at it as like case by case study, I guess, that you have to do. So yeah, that's where I'm seeing it heading. What do you think, Tim?
Yeah, I mean, definitely Midwest, and being just specific places in the Midwest. So we've learned stick with pick some markets and then just buy heavy there. Like we own a ton in Sumter, South Carolina. We own a good amount in Albany, Georgia. We own a good amount in Spartanburg, South Carolina. And it's funny, I think in the last 6 months or so, maybe 6 to 9 months, I saw a lot of really good deals in Illinois. So, not necessarily Chicago, but still Illinois. And there was something like 2,000 lots, I want to say, for sale at one time. And honestly, if it was anywhere else, definitely something worth looking into. But with that being said, I know if there's big operators selling 2,000 units in a state that, everyone already hears stay away from Illinois. It's too blue. And it's okay, if someone smarter than us, who has more experience than us, is selling all their portfolio there, it's probably a good sign to stay away from there. But yeah, I like the Midwest for cash flow. And that's what our deals do, right? They're cash flow heavy. We're hitting investor prefs in the first year, generally, full pref. And now going forward, that's a big thing that we're looking at too. It's how well does this cash flow? And I know a lot of people say, the Midwest cash flows well, doesn't appreciate a whole ton. And that's kind of just about in our wheelhouse, low, slow cash flows, few small levers to really increase the value of the parks. Not big value adds, just small value adds. It's kind of right in our wheelhouse.
Yeah, exactly. I think, since we are in the commercial real estate, right, the appreciation is mainly focused on rent growth, but if you buy under market rents, that already is a huge boost to the valuation, obviously, because it's all based on net operating income, right, the NOI. So you can basically go in every market that doesn't appreciate a lot, but you can force the value based on something that's underperforming as is. And then you just ride the wave, whatever inflation brings to you. And real estate is probably the best asset out there to hedge inflation. It's a hard asset. So at that point, you're just going to grow with the market. And then it's really that simple as looking at, okay, what kind of market are you in? Is that market growing or is it falling apart, right? And we looked at deals before where it had sizable scale, but the market had 30% declines. They lost half the population in 30 years. You don't want to be in those markets if it's all at market rent. So you're not going to grow significantly. You can maybe do every 2 or 3 years some rent increases, but it's good to come in our last year in Albany. We closed up the race in 7 days or less, the capital raise that is. There were half of market rents right there. If we do nothing but just move up to market rents the next 3 years, we already have a 2x equity multiple of our investors, right? So it's a very simple thing, and the tenants accept it too, because they realized they got a really good deal with rent the last couple of years because they were way on the market. They can easily go online and say, oh yeah, this park next door pays $475 lot rent, we pay $225, let's better be quiet. So if you move it up to $315, everyone that sucks, but it's still cheaper than $475, so they stay. And of course, that's why we love mobile home parks. Moving these homes out is very expensive, right? So we have very sticky tenants on top of it. So I always love to look at parks, even if they're in a new market, if the market of course has to have some good fundamentals, but if they're under market rents significantly, it's so easy to drive value out just going to market. And we do it sensitively, right? Those 2 to 3 years stair stepping up to market, and others do it differently. We don't accept with that ethically because we want to solve the affordable housing, issue and not fuel it by like doubling rents in year one or month one. We're not gonna do that, but we're also improving the communities as we do in the upgrades. So it kind of catches up to, okay, now we are market rent in year 3, but we also improved by like, paving sandy roads. I mean, some parks we bought that had a sand road. There was not even like pavement there. So we paved the roads, and then in the same time, we're going to increase the rents. So it's reflected by the quality of the park as well if we increase rents. And I think that's our, like, it's not like low value, but it's also not like this heavy, super heavy lift where you have to fill up like a half empty park, but it's kind of like in the middle. And it's kind of a really sweet spot where we're really strong at. So I love that strategy.
I agree with that. Low and slow, nothing crazy, just operate it better and just go up to market rents slowly but surely. The last thing I really want to say in this podcast, because I personally have to go in a second. So many people who really know like trends, like people that I follow, have been talking about putting money into something like a hard asset, something that really retains its value, because the trend is that the dollar is getting weaker and weaker and weaker. And I mean, who knows what's going to happen with Iran and all that stuff. But usually in war, people, like the governments, are printing money, like historically. So I'm doing my best to make sure that my money is into these hard assets, like hard cash flowing assets. And of course, mobile home parks are great for that. It's, produces cash flow super well. I mean, there's always that need for affordable housing. As the dollar becomes weaker and weaker, that just makes the value of our asset go up and up and up. So it's like, okay, like, sure, I could wait to do this, but really waiting seems like it's just shrinking and shrinking and shrinking the value of their portfolio. Their money is all of a sudden not buying as much as it used to. So just holding on to it and whatever, it's too risky for me. It's too risky to keep on the sidelines. I'm very proud of what we're doing, and I'm very glad that we are making the decision to really buy up as many of these as we can, make them better places to live for people, and make it so it's a win across the board for everyone involved.
Yeah, well said, Tim. There's not a lot we can guarantee, but I can guarantee you one thing. There's nobody out there ever that said, I'm regretting buying this piece of real estate 20 years ago, because it's all gone up in value so much. And that's exactly what Tim was just saying. So that we need hard assets because they're really good inflation hedges, especially with how the administration is currently running. It's very inflationary, just how it is. But when you're in real estate, you actually like the inflationary environment because it drives up rents, drives up values, asset values, etc. So, and actually devalues the debt that you have on the properties. So you build that spread between like your income and actually the debt is staying the same. It devalues the debt while you have inflation. So that's super powerful. That's why we love real estate. That's actually ultimately why I got into real estate, is because to own hard assets, because of having an inflation hedge. So I love it. There's no other game I want to play right now. That's why I have the Monopoly board in my bank, always reminding me like I'm playing this in real life.
Yeah, 100%. I love it. Yeah. So thank you all for watching. If you have any questions, hit us up. We'd love to talk more, and get on our email list if you aren't already, and you'll be one of the first people to see any of our deals and our fund when it's open, so you can make sure to get in it. But yeah, that is all we have for today. Thank you so much again. Thanks, Matthias.
Thanks, everyone. Thanks, Tim.